What up? It's Ruben from TGE, and in today's video, I want to go over 10 pro rules that you can use to pick the right option contract, and that will actually help you make money because there's a lot of traders out there who pick the wrong option contract. They either bleed out, they uh, they barely move, or they just get crushed by volatility, and then you're just losing money at that point. Okay, so let's go over this list here. And the more you do this, this will become second nature to you. It will be so easy. All right. Um, Today's update for progress is that we're actually breaking out of this 53% and going into the 54%. I actually do have a couple setups, and I went over a video earlier about the PDD update. So I updated that. If you want to check that out, there's a YouTube video on there. You can just come here into the group and check that out as well too. Okay, let's get into this top 10 rules to follow. All right, let me write this down. So let's say top 10 contract selection rules. Okay, let's do a fun one here. I'm a big fan of this like Comic Sans. All right, I'll put myself here. All right, so let's start with number one. All right, and we'll go over one by one. Number one, let's say that first start with delta, not price. Okay. And so what I mean by this is that there's a lot of traders out there who they want to look, when they're getting into a contract, they're like, oh, I want to aim for the 120 strike, for the 120 price level of a stock, like for example, PDD, because that's the price target that you have set out to have. And that's okay. In a way, that's a fine price target. You have your own reasoning for that. But when it comes to selecting a strike, it's very important that you just don't pick the price level as a strike, because that can be if you pick that strike and you're not looking at the delta, that may have a low probability of getting in the money, or at least even at the money. And so what will happen is, because we don't know where price is going to go, if price stalls out throughout a couple of days or whatever, and you have a low probability, low delta, time decay is going to eat up on that contract. There's actually something called delta decay, right? Because theta is just destroying the delta. So, um, so if time destroys your delta and it finally starts moving, your contract is going to have to work even harder to even become profitable. So it's important to not pick lottery tickets, right? Always check that you have a solid delta here. I'm going to write some notes in here. I'm going to say at least aim for deltas. Aim for, I say 48 to a minimum delta of 25. Okay, delta, to have actual probability of actually making you money. Okay, if you don't pick this, that could be tough. All right, number two, avoid low volume and open interest. So any low volume or open interest of contracts, avoid them. Okay. The problem with this is that when there's no liquidity equals wide spreads, which equals practically instant losses. Okay, you're instantly losing money when you pick contracts that have low volume or low open interest. All right, and you'll see it all the time. Like if you ever take a look at like SPY, if you look at the option chain in SPY, there's a lot of volume, a lot of open interest. It's a very liquid stock. And so what ends up happening is that, for example, like SPY, you have very like penny wide spreads, right? It's like if you pay $1, the next price is $1.01, right? But if you pick anything like MongoDB that has such low, the option chain is practically dead there most of the time. Um, it's, you have like 50-cent spreads, and if you get filled at the ask and the last price is somewhere in the middle, you're practically starting red already. So like there's no point in picking contracts, even though the setup for that security looks solid. If the option chain looks like garbage, where like there's no liquidity, there's no volume, there's no open interest, high open interest, then it's just better to avoid that. There's no point in entering option contracts where there is uh, no liquidity. All right. So that's number two. All right. Number three, use the chain, not just the chart. Okay. And so what I mean by this is that when you're taking a look at the contracts, right? See where the deltas are, okay? Typically a 50 delta is at the money, right? And so here's a secret, right? Like if the 50 delta is far out of the money, whether it's on the puts or on the calls, then there's some skew there. The delta alone can be a good signal of like, okay, it's favoring the bull side if it's a little bit far out of the money. You'll see this a lot when you go into leap contracts. When you go into like leap expirations, the further the expirations, you're going to see typically, like for example, Nvidia is a great example, or Tesla. The 50 delta is so far out of the money, and me as a trader, that gives me a signal like, okay, the expectations for this is getting bigger and bigger for this ticker, but to the call side. And when we have these crazy market crashes, you'll typically see the reverse. You'll see where the 50 delta is really far out of the money for the put side. Okay, so that's a good signal. And also take a look at IV. See if implied volatility is increasing on the way out in expiration. That could also indicate that the expectation is high. And does IV drop at some point? If it drops at some point, maybe it's like, okay, it went up this high at this point, and then it drops the next week or the next month. That could be some sort of signal as a pullback, right? So just look for things like that. All right, always use the option chain here. So check deltas for bullish. I say check deltas or IV skew for bullish or bearish signals, right? Now these are not you're gonna have other convictions to either go be a bear or a bull, right? But you get the point, right? You want to be able to use the option chain as much as possible, because you can get uh, uh, a lot of good gems out of it. Okay, number 4, don't fight IV crush. All right. So when you're picking contracts and there's earnings, honestly, don't pick contracts that are going to lose. Okay, you could get further out expirations. Okay, so it's all when we're trading when we're trading close to earnings, for example, like MU. We know MU is one of our, inside our Telegram group, that's one of our favorite tickets, because we know that the company is solid from here until like the next couple of years. So trading MU for earnings is actually extremely simple, right? But the thing is, like, there is a top for these securities, right? And so to combat that riskiness for MU or for earnings, we like to get contracts that are at least a month, 2-3 months out of expiration, even leap contracts, right? Because if it takes a hit, the contracts will probably be down 25-30% instead of like going to zero instantly, right? So don't fight the IV, okay? Don't Implied volatility can really, when it compresses, it will crush everything. All right. So, and another trick is that you can get before IV starts to rise for these earnings, you could get these contracts like a month in advance, right? So if it's a month out, you can get 2-3 months out to give you that low IV, and then as IV is increasing, it's probably going to increase your option contract as well too, and then you could just sell before earnings as well too. That's another tactic. Okay. All right. So rule number 5, what I would say is pick the right expiration. Okay, so this one, I'll go into more detail. My rule of thumb is this: if you're looking at the daily time frame, pick about I would say 30 to 45 days DTE. Okay, days to expiration. It's all because if you're looking at the daily time frame, you're kind of looking at like a 2 to 4 week span for this thing to play out, right? If I'm looking at the weekly time frame, then pick anywhere from, I would say, 60 to 90 days, right? This is typically my rules. And if I'm looking at monthly time frame, then I'm looking at plus 365, right? 365. I think that's that's DTE, right? So that's like a whole year out. So this way it gives me time because anything can happen in the market. Anything can happen for the security. ACHR was a good example of that. Took 5 days, 6 days, and we paid contracts that were out about 45 days out, and then we had also a 90-day out contract. And it did go sideways for a couple days, but that sideways movement didn't affect the contract. Theta did not destroy the contract, which again did not destroy my delta here, and it allowed me to be profitable by the end of it. Right, we bagged 2 positions, which was one was 65%, and then the next one was 75%. And now we're in another contract, but we're looking more out long term, and we have actually a leap contract for that. Okay, and we're already up like about 18-20% on the contract. So always give yourself enough expiration time to be able to capture these, to let the trade play out, right? So that's that. All right, avoid cheap contracts is number 6. Avoid cheap contracts. Now, I know I talk to a lot of traders. We get on these calls. I think, let me see. Yeah, does not equal good. Okay, so a lot of traders like to pick cheap contracts because it's budget friendly. Here's the problem with that. This leads to picking the wrong expiration, and it leads to picking really bad contracts that have low probability. Okay? So avoid cheap contracts. If you cannot afford it, that's okay. Find another ticker that is budget friendly. Like there's Ford, Apple's typically good. SPY's typically good. But the further you go out, it does get more pricey. Avoid Tesla if you cannot afford it. Avoid, uh, I believe ZS. Tickers that are expensive. Okay, because most of the time, cheap contracts are cheap for a reason, right? Like there's no real odds, there's no real edge to that contract. You could be right about the direction, but if the contract is garbage, it's garbage. You're gonna lose either way. Okay, so avoid cheap contracts. All right, number 7. Now this is something that I talked about with liquidity here, right? Avoiding low volume interest, but watch spreads. Okay, when you're picking a spread, you want to make sure. What I like to do is I like to pick contracts that don't have pick bid and ask spreads no more than 10 cents. That's like the most spread I will ever have on a contract. Okay, because the worst part about having anything more than 10 cents, from my experience, is that you could get at the mid, and then the price goes up, and then sometimes the spreads even get even bigger. It's just it just goes to show that, like, there's no liquidity in this contract itself, or potentially in this whole option chain for this security. So it really just puts you at a spot where it's harder to sell, right? Because you're already red. And even if it goes up, it could take a while. That happened with one of the MDB trades, which is why I brought it up. I got MDB, and even though it went my direction, the spreads were so wide, and I was still red. And I was like, "This sucks." Like it happens sometimes. I'm so into the other components that make up a trade that I forget to look at the spread sometimes. But I try to make note of this every single time that I before I get into a contract. That's why most of the time I just pick contracts that are just or options that are just very liquid because then I don't have to pay attention to this kind of stuff, right? So that's another way to avoid it. Just stick to liquid names, liquid tickers like Tesla, SPY, QQQ, the mega caps. Those are all solid ones. All right, number 8. Okay, match. This is very important. Match contract size, or I would say dollar amount to your risk. Okay, and so what I mean by this is that this is the number one reason why a lot of option traders fail. I used to run a journaling trading software, and I had a few members there, and most of the reasons why they always lose, and this is the number one reason, I promise you, it has nothing to do with emotions or anything. It's just math. Okay, is that traders would go into a trade that was too expensive for them. So it pretty much forced them to practically full port, almost like 50-60% of their portfolio. They would either be right and have a huge spike in their portfolio, which was good at the time, but they did the same habit again to the next one, and then it would tank. Okay. And then they want to go into the next trade with, like, let's say they just started with a $20,000 position. They won, it went to 40, and then the next trade they put in 30, $40,000, oversizing, and then it just dropped all the way back down to like 5 grand. And then they want to go to the next position with $500, right? It just doesn't make sense. Like, you're not going to be profitable with that type of wide deviation on your sizes, right? You will lose. Period. Like, that is the number one reason why all traders lose. That is why I lost probably like the first 2.5 years of my option trading career because my sizing was just so off. And this happens to everyone. They don't realize it because they're so into the moments. They're so into like trying to catch or chase the opportunity that they just like buy contracts. They're like, oh, my rule of thumb is 20 contracts or 10 contracts. That doesn't work. You got to buy contracts that are no. I always tell everybody, all my students, 1 to 3% sizing of account of net liquid. Okay, net liquid just means total account value. Okay, let's use big words here. Oversizing is the number one reason why traders fail. Guarantee. This is the number one reason. I promise you. So if you get anything out of this video, make sure it's number 8. I'd rather you have an undersizing problem than an oversizing problem. Stick to 1 to 3%. If you don't like the 1 to 3 because it doesn't feel like you're making any money, add more money. Work more, put more capital in there to a point where the 1 to 3% is not a big deal, you know. But if you have like a $10,000 account, you're going in with $1,000. Good luck. If you're going in with, I've seen traders go with $300,000 and they put $50,000. That's more than 10%, right? That's a lot of money. So it happens to all sizes, and I would highly recommend have a stick to your 1 to 3%. All right, this is a long term thing. This is the only reason I've been able to have this type of success. Okay, is because my sizing is on point on every single trade. I have the same consistent size on shares and on options. And my risk versus reward allows me to capture big moves. Okay, so you'll see a lot of like staleness, like the last couple of videos, you'll probably see that my account fluctuated between 53 and 50. So it was like this, right? It was just, and now because I picked opportunities that are 1 to 7, now potentially you're going to see the next leg up, right? It may happen. Maybe it'll just drop down back to 50. Who knows what happens? But that's the whole point. Okay, sizing is your biggest defense tool that you have. All right, so that's number 8. Did I miss a number here? Let's see, 1, 2, 3, 4, 5, 6, 7, 8. Okay, so number 10, always have an exit plan before you click buy. This is really important. I talk to a lot of traders, and they don't understand. They don't understand. They don't understand where they're going to exit. Okay, the way we figure out how to exit in trades is that we use the expected move formula. Okay, for example, if we're taking a look at the daily time frame and we're trying to figure out what's the ideal price target, we always like to use the expected move to give us ideal price targets. Okay, so this way you have a range bound. So for example, let's say that the stock is right here. Let's go and let's give you an example here. Let's say this dashed line is the current price level. Okay, and the next, if you do the expected move, you should have hard price levels here that you should follow, right? So if you have that one there, this is the range, right? Now, whatever you conclude to your thesis, you should always have aim for this target, and then that's it. Like that, you should be practically out of your position here. Okay, so if the price goes up, this is where you take majority of profit, or if it's going to go down and you're betting down, this is where you can take the profit right there. How do you get the expected move? I'll give you a DIY version right here. Okay, now Gextron does this is more tweaked. All right, so if you want to get more accuracy, I recommend you using Gextron. But if you just want to do a DIY version, here's the formula. Get the ask price, say at the money ask price, at the money call. Ask price plus at the money put ask price. Okay, this is how you get the expected formula for this. This is like the DIY version. Right there. Can I underline this? Okay, that's how you get this, right? So now you know what your profit targets are and probably stop before the trade even goes, right? So if you know that if the current price level is this and it's going up and you get in, and if it goes below that past current price level, then probably that's your exit zone right there. Okay? But this would be your profit target right there. At least some majority. It doesn't mean it can't go higher. It can definitely go higher, and then that would be just the power of supply and demand. But at least by this point, you should take all your capital out. All your positions should be sold out. All right, number. I feel like I'm missing one, but I did have one here. I was missing it. Okay. Yeah. Know your profit target and stops before the trade. Very, very important. All right. I went a whole thing about switching these bullet points. Hold on. All right, number 10. Use option tape and equity tape. Okay, this is also known as time and sells. So right, it's just a timestamp of when a trade was executed. Now, Gextron has this tool where you will see every single option order being executed. Even sometimes I even see $5 option dollar premiums coming in. All right, so I like to look at every single order that's coming in to confirm if this move right here is going to happen. If let's say that this is a support zone right here, is there a lot of aggressive buying? Is there buying in general happening on the equity tape and on the option tape to support this move up? If there is, Gextron will let me know, and I can confidently go into this trade to hit my profit target. Okay. A lot of traders want to see like just a candlestick pattern or just alone and just the volume indicator alone. But the problem is that it's not. It tells you the activity that's happening right then and there, but it doesn't tell you from who though, right? Is it from buyers or sellers? And then you'll try and figure something out in your head. You'll try to guess like, okay, the candlestick is bullish, um, and there's a lot of volume activity. Even though those are great indicators, it doesn't really tell you what's happening, right? The tape will always tell you what's happening. That is literally real time, right then and there. Now, option tape, you can't see that on a brokerage, but you can see the equity tape, which is called time and sells on your brokerage account. If you're using like Thinkorswim, Webull, probably the pro desktop version for Fidelity, I think it's called Active Trader Pro. But the option tape, you're definitely gonna have to find another piece of software for this. Now, Gextron has this for sure, and I like to show it next to the equity tape because then you could kind of see it all then and there, which gives me the confirmation. Let me see if I can pull up TradingView here. It gives me the confirmation here that that I can get into this trade. For example, here is ACHR. Okay, when ACHR was taking off here on this P-trans level, there was a lot of buying happening around these areas when it retested these areas, these AOIs, 11, 1050, 12. Um, there's a lot of buying happening, and I would see highlighted background green, so I can visually see like, oh, okay, there's a lot of option buying and also equity buying. It just gave me more confident that I was in the right side of the trade. That's it. All right. So highly recommend you use these. All right. If you do all these 10 things before selecting a contract, you should have a higher probability of coming out profitable. Okay. And I know it may seem like a lot, but the more you do this, it just becomes second nature. You don't even think about it. I don't even think about number one, number two, number three. Uh, Number four happens every now and then. Five, it's just all of this is just second nature. Like I, I do. It's just repetition. You do it, and do it, and then it just becomes automatic, and you don't even have to think about it. All of this just becomes second nature. It becomes like instinctual, you know. But these are definitely the top 10 contract selection rules that I have before I even go into any trade. It's all about having the highest probability to be able to win and come out profitable so you can achieve this type of result. All right, cool. That's it for this video. If you have any questions, leave a comment down below. I'll have a couple links down below if you want to trade with me, and I'll see you in the next one. Peace.